Hi guys, welcome to another video from Little Too Simple. Elon Musk, Steve Jobs, Mark Zuckerberg, and Sergey Brin. We celebrate these entrepreneurs for their successes and often equally praise the venture capitalists who back their startups and share in their glory. Well-known VC firms such as SoftBank and Sequoia have cultivated a branded mystique around their ability to find and finance the most successful young companies. Forbes even identifies the top individual VCs on its Midas list, implicitly crediting them with a mythical magic touch for investing. The story of venture capital appears to be a compelling narrative of bold investments and extraordinary returns, but the reality looks very different. Behind the anecdotes about Apple, Facebook, and Google are numbers showing that many more venture-backed startups fail than succeed, and VCs themselves aren't much better at generating returns. For more than a decade, the stock markets have outperformed most VC firms. Since 1999, on average, VC funds have barely broken even. The VC industry wouldn't exist without entrepreneurs, yet many entrepreneurs feel as if they're in the back seat when it comes to dealing with VCs. For someone starting a company, the myths surrounding venture capital can be powerful. In this video, we will challenge some of the biggest myths about the VC industry, so that founders can develop a more realistic sense of what it really offers. A lot of effort goes into making these videos. If you like this kind of content, please give the video a thumbs up, subscribe to our channel, and feel free to share it with your friends and family. Now let's roll. Venture capital is the primary source of startup funding, but historically, only a tiny percentage of US companies have ever raised capital from VCs. And today, the industry is contracting. But less venture capital doesn't mean less startup capital. Non-VC sources of financing are growing rapidly, giving entrepreneurs more choices than ever before. Angel investors fund more than 10 times as many companies as VCs, and their share is growing. Crowdfunding has become another major source, where entrepreneurs raise small amounts of money from a large number of people. Initially, this was in exchange for non-equity rewards like products. But with the passage of the Jumpstart Our Business Startups (JOBS) Act in 2012, crowdfunders can now invest for equity as well. This makes crowdfunding a powerful way to raise funds for startups. VCs are often portrayed as bold risk-takers who back revolutionary ideas. True, they take a lot of risk, but with their investors' capital, not their own. In most VC funds, the partner's own money accounts for only about 1% of the total. The industry's revenue model, long investment cycles, and lack of visible performance data make VCs far less accountable for their performance than most other investors. Even if your startup fails, the VC firm may still do just fine financially. Why? Because of the 2 and 20 model. A 2% annual fee on committed capital over the life of the fund, plus a percentage of the profits when a company exits, either through acquisition or IPO. For example, a VC firm with a $1 billion fund charges a 2% fee, that's $20 million annually, just to cover expenses and compensation. 3 years later, if they raise another $1 billion fund, that's another $20 million per year, totaling $40 million annually. These guaranteed management fees insulate VC partners from poor returns. Many partners still take home 7-figure paychecks, regardless of investment performance. A common VC pitch to entrepreneurs is, we bring more than money. We bring expertise, contacts, and guidance. And in some cases, that's true. But the quality of mentorship varies tremendously across firms and even across individual partners. Some VCs are highly engaged and helpful. Some are moderately useful. Others do little beyond writing a check. And that's not necessarily bad. Some CEOs prefer independence. But for founders who expect hands-on mentoring, it can be a major disappointment. There's no solid data on how much mentoring value VCs truly deliver. But if you asked 100 VC-backed CEOs, the answers would range from amazing to not helpful at all. This is probably the biggest myth. Yes, a tiny group of top-performing firms do generate spectacular returns. But it's hard to know which firms those are, because performance data isn't consistently available. On average, most funds break even or lose money. Despite the perception that VC is high risk, high reward, the overall industry hasn't lived up to the hype. Entrepreneurs who feel crushed when VCs decline to fund them should remember, VCs as a group don't actually have the Midas touch that people imagine. Many founders believe that signing with a large, well-known VC firm brings credibility, just like MBAs take pride in getting jobs with big-name companies. But studies show the opposite. Fund performance declines as fund size increases beyond about $250 million. Small and medium VC firms often outperform the larger ones in net returns, so bigger isn't necessarily better. It's ironic that VC firms brand themselves as champions of innovation, yet the VC model itself hasn't changed in decades. More funds, more money, bigger funds, declining returns. But the structure of funds, the way capital is raised, and how partners are paid, these things remain exactly as they were 30 years ago. Meanwhile, new financing options, angels, crowdfunding, and others, are shifting power back towards entrepreneurs. The historical balance of power, which was too tilted toward VCs, is finally changing. Thanks for making it this far into the video. Let us know your thoughts in the comments below. If you found this video interesting, please like and share it with your friends. And don't forget to subscribe for more videos like this one. Until next time, have a good one, guys.